Hello and welcome to all our viewers and listeners. Today evening, we have very two distinguished guests with us to discuss the big elephant in the room. Is the Capex cycle really back? Will it last? We have two experts who will help us answer this. Let me quickly introduce them. Vinayak Chatterjee, leading expert on infrastructure in the country. He's also the chairman of CII Council for Infrastructure. Charanjit Singh, been tracking the infrastructure sector for the last 16 years. He's also the fund manager for DSP Tiger. We hope to get great insights from them today. Personally, and on a lighter note, we have a Bong as well as a Sardar today. So let's see how it goes.
Thanks, Sandeep. Yeah.
That's one of the finest introductions I've ever got in life. Sure.
Okay, Vinayak, wonderful. So with that, let me shoot the first question to you. Vinayak, we are all saying that there is some improvement in the private sector capex, but ultimately the public sector is going to play a very important role, the government, right? And you obviously have worked with the government and government authorities, agencies so closely for so many decades now. So, what is the thought process of the government on public spending? What sectors are the focus?
Okay, so Sandeep, for your viewers, this subject on infrastructure spend, capex, economic policy gets very complicated and gets very intellectualized. I want to deconstruct it. So what I'm going to ask your viewers to do is to just have a mental picture. Sandeep started off by talking about the elephant in the room. I am now going to extend that imagery to talk about the very large aircraft on the runway. The big aircraft on the runway is infrastructure development and infrastructure capex spend, right? And it's on the runway and it's ready for a fairly robust takeoff. Why do I say that? Now, once again, going back to the aircraft allegory, it's a very large aircraft because infrastructure spend targeted of 20 lakh crores per annum requires you to have an imagery of a very large aircraft. Now, think of a very, very large aircraft with two engines on the left and two engines on the right. Let's take a look at the two engines on the left. What I'm actually trying to do is I'm actually painting for you an economic structure. The two engines on the left are the national infrastructure pipeline and the national monetization pipeline. That is one of the driving motive forces for the visible next 5 years. Now let's take a look at the wing on my right hand side. That is powered by two very recent enabling implementing factors, again part of government policy, the National Single Window Clearance System and Gati Shakti. They are very involved software programs and platforms that enable seamless and much better implementation of infrastructure. So you've got an economic construct which is powering this aircraft to take off. Now, when any aircraft takes off, there are tailwinds and there are headwinds. Basically the tailwinds, which are favorable winds, are essentially two. The setting up of this mammoth DFI, Developmental Financial Institution, capitalized initially with 20,000, 25,000, 20 plus 5, 25,000 crores of equity to be leveraged to 3 to 5 lakh crores, which is work in progress. That's going to add substantially to the public expenditure pool. And the second is actually a political economy issue, which is very important and analysts often miss it. It is that the politician has realized that to win votes, you need to deliver utilities to the people. So the resounding 2019 general elections was based on gas connections, electricity reaching houses, rural roads, and other kind of deliveries. In 2024, the massive expectation is that it is Nal Ke Jal. The last point I want to make is that for any aircraft, there are also headwinds. In my view, the headwinds are really revival of the PPP process, the confidence in public-private partnerships, because 40% of the capex has to come from the private sector. And Sandeep alluded to it. That we have to rebuild confidence among domestic and financial investors in the robustness and neutrality and governance of PPP structures. We have to improve the liquidity flow to EPC companies. And we have to very carefully watch the capex spend of states. I always joke that 99% discussions are about central government expenditure, whereas 60% of infra spends come from Sigma 29 states. So I present to you this model, but here in your mind, this is the broad construct that I want to present to you to shape our thinking. A large infrastructure aircraft waiting to take off, two engines on the right, two engines on the left, tailwinds and headwinds. Back to you, Sandeep.
Thanks, Vinayak. That was a great analogy. And Charan, if I may begin with a very basic one, and then we will get into more details. What is a capex cycle, and why is it so relevant for the markets, for our viewers?
Yeah, thanks, Sandeep, for that very pertinent question. And thanks, Vinayak, for setting up that context for the overall infrastructure spending. So if you look at capital cycle, so when you look at the capital flows towards the sectors where you see high returns. And as the returns continue to be, more favorable, more and more investments happen in the sector. So what, as a individual, you have to always see the demand supply in any particular sector. When the demand far outpaces your supply, that's the time where your capacity utilizations go up. That's the time when the corporates start thinking about doing incremental capex and the capital cycle starts. So in a way, the demand growth is one of the essential parameters for the capital cycle to pick up. Generally, what we have seen is that any capital cycle, the pickup, government has to give the confidence that they are going ahead, starting the spending. As they push the spending, like Vinayak talked about, as that aeroplane picks up, private sector follows that. Private sector gets more confidence in terms of the demand growth, and then the capital cycle picks up with the manufacturing capacities getting added in either in steel, cement, or the other sectors. So that's how the capital cycle is shaped like.
Super. And Vinayak, we were already speaking on how the government is looking to act as a demand driver for this entire capex cycle. But you also alluded to the private sector not necessarily having the kind of confidence it needs to have because of the events over the last 20 years. So, do you think the government is doing enough to revive this sentiment in the private sector that public private partnerships are really going to work?
I personally think that to revive confidence on PPP, the government needs to do two more things very, very urgently, which we have been pressing the government. We need independent regulators. The investors have lost confidence in what is called level playing field. If you take the railway contract, which is as recent as a month ago, there were 113 parties, very large international companies also, that evinced interest in the pre-bid meeting of privatization of trains. When it came to the bid, only two companies bid. One is Sarkari, IRCTC, the other is Mega Engineering. So what happened to the balance 111? Many of them who were contacted by journalists, I spoke to a few of them, said, we have lost confidence that the railways will provide a level playing field. The same is happening with the bids for the BharatNet, optic fiber linkages to the Gram Panchayats. So we need an independent regulatory body that gives confidence that there will be a level playing field. We need an institution like 3P India, which Mr. Jaitley announced in his first maiden budget in July 2014, PPP India, which will be a knowledge think tank that will harmonize the learning of all PPPs.
So, Derai Durustai, it seems, and good that the government is acting as a demand accelerator. So, back to Charan for another one. Charan, many of our viewers, listeners closely track the markets, right? So, one quick question here is before we get into what sectors will actually benefit, what really is the current capacity utilization across various sectors that you are tracking?
Yeah, so Sandeep, when we look at the core sectors, those are cement, steel, and power. These are the largest spenders, which were there also in the last cycle, and those are the ones who drive generally the capex cycle. Now, if you look at cement right now, as in Q1 FY22, the utilization levels are at around 76%. Steel, the utilization levels are at around 72% in the first quarter. And lastly, when you look at the coal-based or thermal power plants, the PLFs, which are the plant load factors, is at around 59%. So while on the face of it, steel, cement, you will see that the utilization levels are lower than the threshold levels where the new capacity additions can start happening. But when we drill deeper and when we see the utilization levels for the top 5 players in steel and cement, they're already above the threshold levels to start adding capacities. That is what is triggering the announcements being done by the steel and cement players in these sectors to go ahead and start adding new capacities. Other aspect which the viewer should understand is adding a steel or cement plant takes 3 or 4 years time frame. So if you have to add, if you are bullish about the growth in the demand for steel and cement in next 3 years time frame, you have to start adding it right now. So you have to start announcing and start planning and ordering out right now. So that's where we see that as these utilization levels will ramp up, before that, the companies have already started announcing and thinking about adding new capacities.
Thanks, Charan. Now, two common questions to both of you. And let's start with Charan. Charan, we've had several false starts on this domestic capex revival theme in the last 12 odd years. Why did these starts not continue? That's part one. And part two, this time, is it different?
Yeah, so that's an interesting question. So let's look at the history. 2003 to 2007, we had a super capex cycle. Private sector jumped in, power, steel, cement, everybody was adding capacities. A lot of leverage was taken up by the private players to add these capacities. Government spending was growing, private spending was growing, real estate sector was growing. All these engines were growing, like Vinayak talked about. But then what happened? 2008 financial crisis, the entire global meltdown. We saw that this demand started slowing down. There was a lot of policy paralysis which started coming in. There was leverage on the balance sheets, and companies could not sustain that leverage. So from a time frame of expanding balance sheets, companies started getting into contraction of the balance sheets. 2014, the government started taking a lot of initiatives to clear up the bottlenecks, to clear up the policy paralysis. And that is where we got the confidence that we can have again the start of the investment cycle. But then what happened is that FY15, we had a global commodity crash. In 2016, 2017, we had demonetization and GST getting implemented. Then in September 18, we had an ILFS crash. So there were multiple events actually which just truncated our investment cycle to pick up. And now we got a COVID impact, which again impacted the cycle. But we see that why now it is different. I think that's another important question to answer. Because what we are seeing is right now, a lot of these factors are coming together to drive the cycle. Be it government's favorable policies for the infrastructure spending. Secondly, in terms of the corporate balance sheets, which are much more stronger. Thirdly, banks' balance sheets, where the NPAs have come down significantly. And if you look at the last 3 to 5 years, government has done a lot of reforms. So we have come out of that painful phase of those reforms getting implemented and now reaping the benefit of those reforms. Be it GST, be it RERA implementation. Apart from that, government has also done a lot of additional things which can drive the investment cycle, such as corporate tax rate cut for new manufacturing capacities has been cut to 15%. That's a game changer. Secondly, they've also implemented performance-linked incentives, which is giving country India as an opportunity to become factory to the world. Apart from this, what I see is that, like when I highlighted that national infrastructure pipeline is giving us now clear visibility for next 3 to 5 years, that this is our goalpost where government is going to spend more than 100 lakh crores, which is 2x the spending what we had done in FY13 to 19. So that again brings in more confidence that government spending is definitely going to take off despite COVID, which will actually drive the private cycle. And then we can have a sustained cycle for next 3 to 5 years.
Thanks, Charan.
Over to you, Sandeep.
Vinayak, your views on this?
No, I think Charan has very ably captured the stimulus or the lack of it on the capex cycle. That was a very, very short but brilliant exposition of the headwinds that happened at different points of time. I think we are looking, I'm going back to my airfield imagery and the plane. I think we are looking at clear skies and clear visibility and all the forces in place for a very remarkable takeoff. We are just poised for it. And God willing, if we don't get hit by a third wave, or if there is no China crash and continuing shortage on the supply side, coal, chips, metals, etc. If we think these are just short-term blips, which I think they are, and I wouldn't get too worried. Barring these, and with all the stuff that has been put in place, and surprisingly, I am now, this government was criticized for saying it doesn't have deep economic thinking. The UPA government had all the PhDs economics. But what I'm finding now is that there is a certain clarity of government thinking in the architecture that has been put in, and there is political will to implement it. Now, when you have these factors in place, and if you don't have any strong headwinds, which I hope we don't have in the global and local economy, what is going to prevent us from actually taking off? All the pieces are in place. So I hope and pray that this time around it's a robust takeoff.
Wow. What's the bigger risk? Demand side or supply side? Demand side, I mean the actual demand being there, and supply side, I mean the ability to set up these capacities.
Okay, so Sandeep, if I break it up into two parts, one is if I look at from a near-term perspective, then definitely my worry is on the supply side. Supply side is causing a lot of disruption because what we are seeing is that raw material prices are going up, freight costs are rising, container availability is an issue. So what we see is that supply side issues have much more near-term risk to this overall theme, but hopefully this should be short-lived and we should be able to overcome all these issues. From a medium to long-term perspective, it is going to be the demand side risk because government has to sustain the spending to give confidence to the corporate sector to go ahead and start investments, and then only the overall investment cycle will pick up and we can have a super investment cycle what we are talking about. So near term supply side risk, medium to longer term demand side risk.
So Charan, now if we are going on the hypothesis that there indeed seems to be a capex cycle that is starting, but every hypothesis needs testing along the way, right? So which are the matrices that investors should be looking at to test whether this hypothesis is turning into a reality or a complete reality over the next couple of years, right? Because as investors, we would keep evaluating based on recent macroeconomic data or microeconomic data. But it would be great if you could tell us which are the numbers we should watch out for.
Yeah, so I think once you understand okay which numbers we actually have to track, it makes a job very easy to keep track of the cycle and where we are in the cycle. So one is investments to GDP as a ratio. What we saw that investments to GDP actually bottomed out in FY21 and at around 27%. At the peak of the cycle in 2007, it was at around 38%. That's one of the important data points which we need to track. As we talked a lot about government spending in terms of government expenditure in different sectors related to infrastructure, be it roads, railways, water, we need to track, and also the financing of that infrastructure spending, how it is getting sourced. Another important aspect is in terms of the implementation of the new schemes like PLI and how our exports are picking up. That's a data point which I would like to track. In terms of project announcements, like we discussed, a corporate would look at the future 2 to 3 years down the line, how capacity utilizations will shape up based on the demand environment, and then they will start announcing the projects. So that announcement pipeline becomes a very important lead indicator to tell you how the cycle is panning out, and that will get converted into order inflow for the industrial companies and then into the execution and earnings for the companies. Apart from that, you will have to also track the third engine, which is the real estate sector. Now we are talking about residential real estate picking up. So how is the sales growth picking up in that segment? How are the inventory levels and how are the new launches? So these three engines we'll be able to track through these parameters. Apart from that, other high frequency indicators like electricity or power growth, cement demand growth, and steel demand growth. These are other important parameters which you can track on a regular basis. This will also help you track the capacity utilizations which are there for the sector, and which is an important parameter to understand how the private capex cycle will pick up. So these are the parameters which I will look at to consistently track the sector.
Thanks, Sharon. And actually, by the way, we do track real estate very closely because many of our viewers are in that age bracket where they are looking and considering to buy a house, and it's one of the most important decisions in one's life. And we have also seen that the demand for residential real estate in first Mumbai picked up last year with the stamp duty cut. Then Bangalore is also going great guns with the whole IT sector booming. And now, actually, in the last quarter, even in Noida, NCR was supposed to be the last bastion to fall after so many 8-10 years of a bad market. But even Noida has started booming. And at this rate, probably by the end of the quarter, Gurgaon will start booming. So I think this whole impetus in residential real estate that we are seeing, with cost of borrowing now down to 7%, which is like compared to a cost of rental of 3%, which means the incremental cost is at an all-time low of owning a house versus renting. I think we are seeing a lot of spillover demand in other sectors. And as we all know, as a consumer, if I feel my house is now worth 150 versus 100 yesterday, I tend to spend more. And that has that entire multiplier effect, which often is underestimated. Yeah. So no, thanks, Charan, for that insight. Now, Vinayak, a quick fire. Your top three sectors where you are most bullish on.
My top sector would be cement, construction equipment, the listed EPC companies. There is a very large movement on electricity distribution. So people who are in the business of supplying equipment and goods to the electrical sector, like smart meters, transformers, relays, cables, etc., transmission lines, electrical equipment. There is still 15 crore households to be connected in the Nal Se Jal program. So companies that are in the business of making equipment for water supply, valves, pipes, taps, are going to see huge demand. And the push on renewables is going to continue with this COP26 discussion in Glasgow and net zero and hydrogen and all that. Renewables will now move from 100 gigawatts to 450 gigawatts by 2030. So renewables companies are going to see huge upside, and the government is making it easier and easier for them to get out of their past problems of lack of offtake and lack of liquidity by the discoms. They're being rectified. So these would be my top areas.
For our investors who are either investing in mutual funds or are investing on their own, right? Many of them invest on their own as well. Do you think there are enough private sector players that they can invest in so that they can profit from them, and the private sector players in turn benefit from this capex cycle? Do you think there are enough players in each of these subsegments? At a very broad brush, I'm not asking you for any names.
Yeah, so I like to touch upon the aspect in terms of the infrastructure or the construction space. The perception is that these companies are very highly leveraged, but you can still see that there are companies which have net cash balance sheets, which have maintained very strong execution track record, and are very much focused on the sectors where they perform, and now they're able to capture that opportunity. So I think what we have seen is that the last cycle has brought in a lot of consolidation in the sectors. There are companies who have survived through those cycles, changed their business models, and now are ready to actually capture that growth, what we see in this next investment super cycle. So definitely there are plays in each of the segments, what we have talked about, which investors can look at to participate in this growth opportunity.
When you evaluate a company for deciding whether it forms part of your fund, what are the top 2 or 3 things you look at?
Yeah, so our framework in terms of picking companies is based on looking at last 15 years of data and looking at what all issues each of the sector goes through. One most important point is that when you are looking at each of the subsector, you need to have a good 3 to 5 years visibility. If I have that visibility, I can go deeper. Then look at companies who have the strong balance sheet and capability to actually capture that opportunity. And then definitely the management quality, which is there, because that is what has actually helped a lot of companies survive, because their managements were very disciplined. They didn't take excessive risk. They didn't go after projects which were maybe lower margin or projects where they saw that there were issues, and that's where they were able to survive and maintain their balance sheets in such a good condition that they can now capture the growth. So I think if you have a very simplistic way, if you have a very clear outlook on the market which you're looking at, growth prospects and companies, and another thing, especially in the manufacturing sector, last cycle we saw coal-based capacities getting added. Now we are seeing renewables capacities added. Now we are talking about automation and digitalization. Now we are talking about data centers. Now we are talking about electric vehicles coming into the overall, ecosystem. So are there companies who have been able to change or bring in the new products which can cater to these markets? That's what you need to look at, and whether they have the ability to actually capture that growth as these new markets evolve. So I think these are the factors which we'll look at whenever we'll evaluate the companies.
Vinayak, any thoughts on this framework that Charan has just shared with us? Would you like to add anything to it? Or you think that's a framework we should be using to pick
No,
out
no.
winners?
Honestly, that's a fair framework. Since I would worry about liquidity issues, I would also track quarter by quarter number of debtor days. That will give me an early warning signal as to whether the company is entering into a cash trap, debt trap or not. I would just add that to say that it's important to monitor the debtor days. But let me talk that in the infra sector, I'm now seeing three classes of investors. And many of you viewers, while they would certainly maybe at a personal level or professional level be interested in listed markets, I actually see the investment in the infra sector coming in three buckets. Bucket is, of course, the listed markets which are coming in through IPOs and stuff like that. Then there is a large number of very interested PE funds and institutional investors. From anywhere from the names that you're familiar with, who are directly investing in the companies, whether it's the large institution like Canadian Pension Fund, CDPQ, CPPIQ, Abu Dhabi Investment Corporation. As you know, they all make chunky investments in companies. So that is a second bucket, which I call PE and institutional. A large number of them are foreign. The third bucket is what is called the institutional instruments, which is InvITs and REITs. That is gaining ascendancy. So when you view when you're looking at investments in the infrastructure sector, I view them in terms of the performance of these three buckets.
Super. In fact, InvITs and REITs is also an instrument that many of our viewers have an interest in. And we have seen recently how well this whole power grid REIT has done. I mean, it's actually done phenomenal. It's delivered, a close to 40-50% return in the last 3-4 quarters, and for a semi-debt instrument. So, do you continue to be bullish on the future of InvITs, Vinayak?
I do. I think we have had some uh, early lessons because it's a new concept. Excuse me, in terms of putting a bunch of operating projects together and then forming a package and then getting retail investors to invest in them. There have been some signals. Now NHAI is almost ready to come up with its first InvITs package of 5,000-6,000 crores, and others have already followed. Some have not done so well because there's been a learning curve and there have been some shocks, as Charanjit has also pointed out. But I think both REITs and InvITs are actually going to be scaling up significantly in terms of their importance to the infrastructure sector.
Charan, anything else you would like to share, including who should be considering to invest in a DSP Tiger Fund, right? What should be the hypothesis of that investor for him to consider DSP Tiger Fund?
Yeah, so if you look at DSP Tiger Fund, it's a thematic fund. So what I would say, it's not a sectoral fund because it actually goes ahead and invests in multiple sectors. And it should be looked at more as manufacturing, engineering, and overall, core economy focused fund. Now, the other point is, when you look at the Nifty 50 constituents, right now the weight of the investable sectors which go into these kind of manufacturing oriented funds, thematic funds, that has come down to only around 25% as of September 21. In the peak of the cycle, December 07, this was at around 67%. So it means our representation in the index is pretty low for these core economy sectors. We are seeing, based on our discussions, the data points, the 15 years of data analysis, what we have done, that the cycle is definitely bottomed out and reviving from here. So how do you benefit from this? So as an investor, you can look at thematic funds, which can add to additional is within your portfolio. You can allocate maybe 15% of your total portfolio to the thematic funds. What you have to also ask is how you are minimizing the risk in these funds, because these are thematic funds, so risk could be higher. So minimizing the risk is through the factor by balancing out cyclical and secular growth sectors. Like you asked about real estate sector is picking up, but what's the best way to play those deep cyclical sectors? Can we have some other way to benefit from that? Definitely, there are ways where we can reduce the risk, bring in more secular growth in the funds. And that can be done through the sectors which are going to benefit from real estate and plus also multiple other factors. For example, building materials like cement, pipes. Secondly, you can look at cables and wires segment, consumer electricals, consumer durables. This entire theme can run on top of the real estate cycle. And then you have to look at the other subsectors like where we talked about, where the growth rate is clearly visible, be it automation, be it good themes within the industrial manufacturing sector, how the fund is positioned. I think that's the way you can look at investment into any thematic fund.
Right. Charan, whenever I invest in a thematic fund, I also want to know when I should get out, because my theory has been that okay, you can invest in top 10 companies or some index fund as a complete buy and hold strategy, but not a thematic or a sector fund. You need to have some semblance of okay, if this happens, I should look to get out. What are those?
Yeah, so I think here comes the when you are looking at the cycle. So this cycle, what we are talking about, we have all the drivers in place. So this cycle is going to be more longer drawn cycle, much more broader based cycle. New capex drivers are emerging. So definitely the visibility for us is good. Like I started with our framework, every sector has to be judged from the point whether we have a 3 to 5 years visibility or not. That's your input. So once your input is clear that you have a 3 to 5 years visibility on the cycle, on the subsectors, that is how the investors should position themselves to benefit from that 3 to 5 years revival in the cycle. And if you don't have that visibility, then those sectors should not form the part of the fund, because we don't want just spikes in terms of particular sector and then it just falls off. We want more consistency in terms of how each of those sectors grow. You can add some of the sectors which have lower cyclicality. For example, now consumable sector, which are industrial consumables, which are very less cyclical. Now I'll give you a data point here. When industrial production was on an average growing by only 3 to 4% over the last 10 years, the consumable companies for industrial sector were able to grow their top line by around 10 to 11%. So that's how you are, managing the cyclicality and the secular parts of the fund, balancing that thing, and you should look at it from a horizon of 3 to 5 years to benefit from the overall cycle.
Super, gentlemen. And for the benefit of our viewers, let me take a stab at summarizing this very stimulating discussion. I think both our expert panelists were of the view that the Capex cycle is back. Not only is it back, it is expected to continue for the next 3 to 5 years, coming as it does on the back of a demand revival pushed by the central government, and also a period of 8 to 10 years where not much capacity has been set up, setting the stage for a revival in the Capex cycle in India. Vinayak mentioned that the government seems to have finally hit upon that right formula now, which is monetizing ready assets, ready road toll projects, etc., to get in the capital, to then use that capital to pump it into early stage assets, because it's only the government that can take some of these very large developmental risks. We asked Charan, what are the matrices we should be looking at to figure out if this hypothesis is playing out as per plan? Is this Capex cycle really back, or is it like one of those false starts that we have had in the last 10 to 12 years? So Charan shared with us, we should be looking at the investment to GDP ratio, how the implementation of new schemes that are being announced is being done. That is something we should be tracking. The sectors that both our panelists felt should do very well, and this should be of interest to our listeners who are also tracking and investing in the markets. One is water supply, other is power distribution. Vinayak, I think, made a great point here that the current government has now realized, particularly after the 2019 elections, that you have to deliver infrastructure to the voter. And that has a clear benefit for the government. Now, with that realization and a strong execution mindset, I think water supply, power distribution will clearly benefit. Besides that, cement construction will be direct beneficiaries of a strong real estate residential cycle that seems to have started. Electrical equipment is another thing that our two esteemed panelists were bullish on, renewables as well, and also technology infrastructure, which includes power charging stations, etc. Some of these themes, both our panelists are bullish on. As in any theme, there are risks. So it is something that we'll have to continue to monitor, seeing what kind of capacity utilizations are finally throwing up. Right now, many sectors seem to be between that 70 and 80%, still not hit that magic number of 90%. But as Sharon pointed out, capacity setting up in these sectors takes 2 to 3 years. And by that time, hopefully we will be at those numbers. We will be monitoring whether those capacity utilizations really pick up. Check out our threads on the Multipie app, where we publish latest data on not only leading macroeconomic indicators, but also financials of independent individual companies. So thank you to our panelists for sparing time, and thank you to all our listeners. I hope it was an engaging discussion. And if you have any questions that you would like us to answer or get answers from our panelists on, do ping us on the Multipie app, and we will try to get in touch with our panelists to get a response to your questions. Thank you so much.
Thank you.
Thank you, Sandeep. Thank you, Charan. It was good to be on the panel with all of you. Thank you.